Hello everyone! In this lecture, we'll talk about the main concepts related to the conduct of economic policy. And here is our study plan. First of all, we will study two types of the demand-side policies, fiscal policy and monetary policy. We will study the tools of fiscal policy, how exactly it affects the national economy. We will use our conventional aggregate demand, aggregate supply model. We will study what are budget deficits and surpluses and how exactly they will affect different macroeconomic variables, and how exactly budget deficit is lead to the accumulation of national debt. After this, we'll focus on the monetary policy again. We will analyze what tools, monetary policy tools, National Bank has at its disposal, what exactly is the transmission mechanism, and how exactly changes in monetary policy will affect national economy. And we will also proceed to the long-term neutrality of money, which is a slightly more advanced concept, which will help us to understand the differences between short-run effect of economic policy and long-run effect. We'll study how exactly contractionary and expansionary policy will affect different macroeconomic variables. Again, we will use aggregate demand and aggregate supply model for this. And towards the end of the lecture, we'll study supply-side policies. Fiscal and monetary were demand-side policies, and we will also analyze different supply-side policies, different approaches advocated by different schools of economic thought, market-oriented and interventionist approaches. First of all, let's have a look at this slide. It will help us to understand why do we need to implement economic policy, why do we need to interfere with the functioning of the free market. The thing is, as we've learned in one of the previous lectures when we analyzed the business cycle, different macroeconomic variables will behave differently at different stages of the business cycle. For example, when the economy is growing, when it reaches its peak, at the peak stage of the business cycle, we are able to achieve high level of output and therefore low unemployment. But at the same time, the country will suffer from high inflation and current account deficit. On another hand, when the economy is in recession at the bottom of the business cycle, the country will suffer from low output and high unemployment level, but on another hand, we will be able to enjoy relatively low inflation and current account surplus. We've studied all of this, how it happens, why it happens, in the previous lecture on the business cycle. This was covered already. In other words, sometimes the government might decide to lean against the wind. In other words, the government can try to smooth out these fluctuations in the business cycle. The government can decide, when the economy is booming, to reduce the extent of this boom, to slow down the growth a little bit in order to avoid overheating, too high inflation. And at the same time, when the economy is in recession, policymakers may implement certain measures in order to reduce the depth of this decline in output and national income, to prevent it from declining too much. And in order to achieve this, in order to smooth out these fluctuations in the business cycle, policymakers will use a variety of economic policy tools. And this is what we will study in this lecture. In order to achieve its macroeconomic policy objectives, policymakers are able to affect aggregate demand and/or aggregate supply. Therefore, we will study demand-side policies first and then supply-side policies. Demand-side policies aim to affect different components of the aggregate demand equation. We've studied this equation during the last few lectures, and I've told you this is the most important equation in macroeconomics. These are components of aggregate demand, and by affecting these variables, the government or central bank can shift aggregate demand curve and therefore affect other macroeconomic variables. There are two main types of the demand-side policies, which are fiscal and monetary policies. They are used to smooth out these fluctuations in the business cycle. Both types of policy, both fiscal and monetary policy, can be expansionary or contractionary. In other words, both types of policy can lead to increase in aggregate demand or reduction in aggregate demand. Let me show you this using a graph. Let's use our aggregate demand, aggregate supply diagram. We have price level along vertical axis and national output or GDP, national income, along horizontal axis. We'll sketch two cases. The first case will be expansionary policy. and another one will be contractionary. We have certain original aggregate demand curve, aggregate demand 0 in both cases. We have certain aggregate supply curve, again starting point, and the starting equilibrium, let's call it point E0 in both cases. This means that originally we produce certain level of national output and we have certain price level in the economy. Then we decide that our economy is not growing quickly enough. We want to stimulate the economy. We want to expand the national output. We want to encourage higher growth. In order to do this, we need to shift aggregate demand curve upwards. New aggregate demand curve is higher. I will explain how exactly we can shift it, why it happens, but this is the general idea. When we shift aggregate demand curve upwards, economy moves to a new equilibrium point, which means that our output is now higher. We've achieved our goal. We've increased our output. It's an expansion in aggregate demand which will lead to an increase in national output. In other words, national output will increase, national output, as a result of this expansionary policy goes up. Why? National output. This will lead to an increase in the employment level as well. Why is that? Because in order to produce higher output, we need to hire more workers. We need staff in order to produce additional products and services. Therefore, employment level in the country will increase. This will lead to a reduction in unemployment level. So as you can see here, we achieve a number of objectives at the same time. Unfortunately, this comes at a price, and the price we have to pay is an increase in the price level. As our economy moves from original equilibrium point E0 to a new equilibrium point, as our economy expands, as we manage to achieve certain macroeconomic objectives, there will be a downside. Our price level goes up. Price level increases. In other words, our inflation accelerates. Inflation goes up too. So these are the positives of the expansionary policy: high national output, national income, high employment level, lower unemployment rate. But on another hand, we suffer from accelerated inflation. This is how expansionary policy works. That is why we cannot use it all the time. On another hand, the government policymakers can choose to implement contractionary policy in order to combat inflation. And this is exactly how it's done. If increasing aggregate demand stimulates inflation, leads to a high inflation, then apparently lower aggregate demand, a reduction in aggregate demand, should lead to lower inflation levels. And this is exactly how it works. If we manage to contract aggregate demand, to reduce aggregate demand, in other words, to move the original black aggregate demand curve towards a new lower level, our economy will move now to a new equilibrium point. In other words, we will enjoy lower price level now. Price level drops, right? In other words, we manage to slow down our inflation rate. Inflation is now lower. Inflation rate slows down. The current price level also drops. Prices in the economy are lower. Unfortunately, the cost will also be quite significant because our national output will also go down. It's a contractionary policy. It leads to a reduction in national output, in GDP and in national income level. This will be the downsides of the contractionary policy. So national output drops, national income drops as well. We earn less, national income will decline. This will also lead to a reduction in employment level because as we produce less now, we don't need as many workers as before. Many companies will need to cut down their production and therefore make some of their staff redundant. People lose their jobs, and as a result, unemployment level will now increase. Unemployment is now higher. In other words, again, we achieve some of the objectives, lower inflation, but at the price of higher unemployment. This is exactly how demand-side policies work. Expansionary policy will shift aggregate demand curve upwards, which will lead to certain combination of changes in our target macroeconomic variables, and contractionary policy will lead to a reduction in aggregate demand. So let me write it down here. Contractionary policy involves a reduction in aggregate demand, while expansionary policy means an increase in aggregate demand. The question is, how exactly can we shift aggregate demand curve? What exactly do we need to do this? That's very simple. In order to shift aggregate demand curve, we need to affect the components of our aggregate demand equation: consumption, investment, government expenditure, and net exports. This is exactly how policymakers can manipulate the location of aggregate demand curve, by affecting various components of aggregate demand. And in order to change this, they have two main types of policy at their disposal, as I've mentioned already: fiscal and monetary. So let's have a look at them in more details.